All right, welcome to This Explainer. Today, we are tackling something that literally affects almost all of us, but somehow we still manage to fundamentally misunderstand it: the Indian income tax system. Now, think about this paradox for a second. When you buy a cup of coffee, you get a coffee, right? But paying taxes, that doesn't buy you a specific product. Instead, it builds the very society we all live in. So let's dive into this whole mechanism and see how it actually ticks.
To keep things super clear, we've got a roadmap today. We're going to systematically hit the basics of income tax, the power to levy taxes, the Income Tax Act itself, tax administration hierarchy, key features, and finally wrap up with surcharges, cess, and exemptions. Let's get right into it.
Section 1. Basics of Income Tax.
We toss the phrase around constantly, but let's actually break down those two words, income and tax. Simply put, a tax is a mandatory monetary charge imposed by a government on its citizens. And I really want to hit hard on that word, mandatory. This isn't some voluntary donation where you just chip in if you're feeling generous this month. No way. The government collects this to raise revenue for collective public development, roads, hospitals, schools, the whole shebang.
And this brings us to a really cool economic concept, basically the no direct benefit rule. Economists like Professor Seligman and Taylor, they define a tax as a compulsory contribution where no special benefit is conferred on the payer. What does that actually mean for you? Well, it means even if you pay a massive tax bill, you don't get your own exclusive VIP lane on the highway or private hospital bed. The benefit is entirely societal. You pay as an individual, but the return, that's shared by everyone. Moving on to Section 2, power to levy taxes. So you might be wondering, where exactly does the government get the power to just demand this money from us? Well, it all goes back to the ultimate rulebook, the Constitution of India, specifically Article 265. It clearly states, no tax shall be levied or collected except by authority of law. This is a massive, absolutely crucial protection for us as citizens. It literally means the government cannot arbitrarily take a single rupee from your pocket without explicit, codified legal authority granted by the Constitution. And this legal authority gets mapped out in this 7th schedule, which basically dictates who gets to collect what. It's split into 3 lists. The union list gives exclusive power to the central government. The state list is solely for state governments. And the concurrent list, that's where they both share the power. It keeps things from turning into total chaos and divides up the taxing authority across the nation beautifully. So where does income tax sit? Right in entry 82 of the union list. That gives Parliament, the central government, the exclusive power to tax income. But check out that really fascinating exception at the end, except agricultural income. By the Constitution's rules, taxing farm income actually falls under the state list, meaning the central government only has the authority to tax non-agricultural income.
Okay, on to Section 3, the Income Tax Act.
Now that the central government has this constitutional power, they obviously need a very specific rulebook to enforce it, right? For decades, that was the Income Tax Act of 1961. It laid out literally every single rate and provision. But we are actually right in the middle of a historic transition. A brand new, comprehensive rulebook, the Income Tax Act 2025, is set to take effect on April 1, 2026, totally replacing that old 1961 framework.
Next up, Section 4, Tax Administration Hierarchy.
So who's actually managing the mountain of paperwork and collecting the funds on a day-to-day basis? Well, at the very top, since we're dealing with national finance, you've got the Ministry of Finance. Right under them is the Department of Revenue. And then, handling the actual nitty-gritty of your income tax is the Central Board of Direct Taxes, or the CBDT. They're the ones making sure rules are followed and revenue is actually collected. To really get what the CBDT does, you have to contrast it with the CBIC, which handles indirect taxes like GST. The absolute crucial difference here is the burden of the tax. Income tax is a direct tax. That means the impact falls entirely on you. If you earn it, you pay it. You cannot shift that burden to someone else. Unlike a business owner who can totally pass the burden of an indirect tax, like GST, right down to you, the consumer.
Section 5. Key features of income tax. All these constitutional rules and administrative structures give the Indian income tax system some very distinct vibes. Like we said, it's a direct tax. You can't shift the burden. It's a central tax, so the revenue goes straight to the central government no matter what state you live in. It's an annual charge, calculated on your yearly earnings, not month by month. And here's the big one. It's a progressive tax rate. That just means as your income goes up, your tax rate goes up. The richer you get, the higher the percentage you're handing over. Now, knowing that the system is strictly progressive, let me ask you something. Think about this carefully. In the context of our income tax system, who exactly are the free riders?
This illustrates a really fascinating, strictly economic concept in public finance. Free riders are basically individuals whose income falls below the taxable limit, meaning they aren't paying any direct income tax. But because things like national highways and public schools are for everyone, they still get to fully enjoy those societal benefits. The financial heavy lifting for funding all that massive infrastructure falls mostly on higher earners, thanks to that progressive rate we just talked about.
Finally, Section 6, surcharges, cesses, and exemptions. Let's get into the most practical part, how this actually hits your wallet. You probably hear surcharge and cess thrown around all the time, right? But administratively, they are totally different beasts. A surcharge is literally a tax on a tax. It's an extra percentage slapped only on the tax bills of high earners. A cess, though, is an extra tax levied on everyone, but it's collected for a very specific, dedicated government purpose, like funding national health and education initiatives. Let's put some specific numbers to it. The surcharge kicks in once your income crosses 50 lakh rupees. Earn between 50 lakhs and 1 crore? Boom, you pay a 10% surcharge on your tax. And because it's progressive, if you're pulling in 2 crore or 5 crore, that scales all the way up to 15%, 25%, or even a whopping 37% for the ultra-rich. Meanwhile, that health and education cess, that's a flat 4% added to your final tax and surcharge amount, universally applied.
7 lakh rupees. If you're an everyday taxpayer, this is arguably the single most relevant figure in the modern tax regime.
Here's why that number is so vital, and you really need to pay attention to this catch. Under Section 87A of the new regime, if your income is exactly 7 lakh rupees or less, you get a full rebate. Your final tax bill is absolute zero. Sounds great, right? But, and this is a massive but, if you earn even 1 single rupee more, so 7 lakhs and 1 rupee, you lose that entire rebate. Suddenly, you're dragged right back into the standard tax brackets, and your tax is calculated all the way from the base exemption limit of 3 lakhs. It's a pretty sharp cliff for sure, and you absolutely need to be aware of it when planning your finances.
So, we've covered the whole shebang today, from constitutional law down to the messy math of rebates and surcharges. But I want to leave you with a final provocative thought. If taxes are, quite literally, the price we pay for civilization, for the roads we drive on, the schools our kids attend, the security we enjoy every single day, are you paying your fair share for the society you want to build? Something to chew on. Keep analyzing, and I'll see you next time.